Well, Meir, I, like Barry, some of the books that you've written were extremely influential for me in the way that I work with clients, the way that I think about helping humans be humans. You can't take the human air out of humans, and so how do we address those issues? And so I thought we could just start at the highest level and let you define what is behavioral finance.
So behavioral finance is the study of the behavior, the decisions of normal people, and how those decisions are reflected in financial markets. It is distinguished from standard finance in that standard finance is about rational people, how it is that rational people make decisions and how those decisions are reflected in financial markets. So people in academia, economists, financial economists, use the term rational more narrowly than it is used in daily life. In daily life, we might say it's not rational to buy a Lexus when a Toyota is essentially it, other than the emblem. What Miller and Modigliani, Merton Miller and Franco Modigliani did in 1961, a very famous paper that is a big part of their Nobel Prizes, they defined rational people very well. They said that rational people, rational investors, prefer more wealth to less, seems reasonable, and are indifferent to the form of the wealth. And the point of that second one is that dividends do not matter. Why? Because if you don't get a dividend from a company, then you can create homemade dividends by selling a few shares just to get whatever, that $1,000 or whatever you wanted out of dividends. So the problem with that is that that is not what people do. People care very deeply about dividends. And so my colleague, Hersh Shefrin, and I wrote a paper in the early 80s where we elaborated on that. And I'll tell you more about that. But essentially what we said is that people prefer dividends for two reasons. One is because they distinguish between capital and income. And second, because they hate to dip into capital. And so this rule may not be rational, but it is normal and pretty smart, because what you're afraid of is that if you give yourself permission to spend 3%, you will say, gee, you know, this time I need more, and you'll spend 5 or 6 or 8. And so, again, there's a difference between what is rational and what is normal. And normal can be pretty smart.
I definitely want to get into some of these portfolio issues, but as you mentioned that you were publishing this work in the 1980s, I have to imagine that your work was initially met with some skepticism from other economists. What was it like publishing on these topics in the 80s?
Well, so it was not a book, it was an article. It was an article published in the Journal of Financial Economics. Now, at that time, sending a paper like that to the Journal of Financial Economics, which is a top finance journal, in fact, we didn't expect it to be accepted. We thought that we'll just get good referee reports that would help us later. And so people outside of academia will say things like, you published a paper. No, I don't publish a paper. It is the journal that published a paper, and God knows they make it so hard to get that, because typically it's kind of like getting admitted to Harvard. 5% of the articles submitted eventually make it to publication. Now, we wrote an article, we called it Explaining Investor Preference for Cash Dividends. And we were exceedingly which tells you what you know, that luck matters greatly in life. The referee turned out to be Fisher Black of Black Shoals. And the man is great in many ways, but he has really an open mind and an ability to really reach out and compare his personal experiences to what is in the literature. And he wrote such a brief but such a positive report that the editor said, after some non-trivial soul-searching, yes, I agree. And so that article was published. But that was at a time when getting a paper published on something that we did not call at that time behavioral finance was extremely chancy. And so it's a combination of the innovation that Hirsch and I introduced and that luck of having Fisher Black as our referee.
I absolutely love that story. And I think that a lot of people, it's so mainstream these days, behavioral finance, and they forget what it must have been like and how it wasn't purely accepted. And I graduated college in 2007 with an economics major, and there was not one mention of anything behavioral finance related. And I took some psychology courses, and there were some mentions there, but not in pertaining to finance. To me now, it's a little bit like when Moneyball came out in baseball, all of a sudden everybody started to talk about advanced statistics. The second generation of behavioral finance is a little bit different, don't you agree? And I would love to hear your thoughts of what it has evolved to in a second generation, and even maybe perhaps touch a little bit on where you see it evolving today.
So in the early 80s, when I started in what became behavioral finance, there were really a very small group of people in addition to Hirsch and myself. Dick Thaler was there. Bob Shiller was there. They are, of course, giants who won Nobel Prizes, and a handful of others. Now, we built on the work of people like Kahneman and Tversky, principally, but other psychologists, cognitive psychologists. And at that time, we had what I call now the first generation of behavioral finance. And the first generation of behavioral finance, in fact, called people irrational. So standard finance said people are rational. The first generation said irrational. And so we had things like overconfidence. So in fact, even today, the first thing that comes to mind of most people when they think behavioral finance is cognitive errors, emotional errors, excessive fear, representativeness, and so on. Well, that is all nice. But the thing is that people really distinguish, or we should distinguish, between what it is that is an error and what it is that people really want, what investors really want. And so not everything that we describe as an error is in fact an error. For example, we know from the literature that the more people trade, the more they lose. So you can describe it as an error. But then you think about video games. Why do people play video games? How much money do they make playing video games? Well, some people are professionals, but for most people, it is just a fun pastime. Can you imagine that for some people, trading is like video games? And so the point that I made is that when we think about any product, whether cars or watches or restaurants, we derive three kinds of benefits from them: utilitarian, expressive, and emotional. And so the utilitarian benefits are: how much money do you make of it? What does it do for your pocketbook? But the Expressive is, what does it say about me? To myself and to other people. I'm a religious person. I'm a fun person. I really enjoy the thrill of driving a fast car. And emotional, the pride. So you make money and you support your family and you have money for retirement. But there is something about having more than that, such that you can create an endowment at your university that brings you this emotional benefit. And so you give up, in fact, utilitarian benefits because you give up money, but you gain more than that. And so in the second generation of behavioral finance, I looked at things like socially responsible investing. Why do people invest in it? Some will tell you that they make extra money out of it. That's not so. You lose money relative to what you would do if you did not, but you gain expressive and emotional benefits. And the usual answer of economists is separate the two. And some advisors will tell you the same thing. Separate the two. That is, I'm here to make you the most money, and then you can use it for whatever you like. And my standard response to that is to say this. Imagine that it's an Orthodox Jew facing you, and you say, listen, pork costs less than kosher beef. It tastes pretty good. Why don't you eat pork and donate the savings to your synagogue? Everybody understands that that is absurd. And for some people, having fossil fuel stocks in their portfolio feels like what it feels like an Orthodox Jew with pork in his mouth. If that is how you feel, don't have them in your portfolio. Don't have these stocks of whether it is fossil fuels or whether it is abortion drugs or whatever has to do with your values. And so this is kind of the distinction is that some things that we used to describe as errors are not really errors, but they are reflections of what people actually want.
I love that distinction, errors versus wants. And I feel like it used to be, like you said, the first generation, it was a lot of, oh, look at you silly little humans. The second generation really delineates between it's okay to want these things, even if it is not optimal. One thing that I constantly encounter from portfolio construction is the type of investments people want. You had mentioned ESG. Another thing that comes up quite frequently would be hedge funds and alternatives, which, to be clear, I don't think are inherently bad, but sometimes the reason people want them can lead to errors. Sometimes they want them for the wrong reasons. Why is it that you find particularly wealthy people have such a high interest in hedge funds and alternative private investments?
So years ago, I was about to speak in Montreal to friends of the Hebrew University, the university I graduated from. And I was speaking to one of the people who was going to be in the audience. Of course, it had to do with investing, and so we were talking about investing. And I said something about mutual funds. And he said, I invest in hedge funds. So what did he tell me? He just told me that he is a wealthy man. Because we all know that the minimum for a hedge fund might be $500,000 or perhaps $1 million. Not everyone can afford that. Did he brag about his riches? If he said, hi, my name is Joe, and I'm a rich man, that's gauche. But you let drop that you are into a hedge fund, and you tell me the same thing, except that it is more than socially acceptable. And so my sense is that when somebody, say, sold a business, say, for $10 million, and he comes to a financial advisor, and a financial advisor says, here is a good portfolio for you that will preserve your wealth and increase it, composed of mutual funds and ETFs. And he says, you know, that's for the little people. I'm a big fish now. what you have that is special that I can speak about to my friends who also have that kind of wealth? Hedge funds, private equity give you that opportunity to really gain those expressive and emotional benefits. And if it loses you some money, who cares? In fact, one advisor who heads a family fund said, I have that owner has a wealth exceeding $100 million. He wants not 5%, not 5 million of play money. He wants 15%. And I was thinking for a moment, and I said, you know what? If you have $100 million, you can lose $15 million and still be okay. So if he finds that it enhances his well-being, let him do that. I don't know if it was the right answer, but I think that it is a reasonable answer.
Well, I think that recognizing your desire for certain types of investments as a signaling device, much like you might buy a nice car, much like the shoes or clothes that you wear, all different forms of signaling status, which again, from an evolutionary perspective, is very important and understandable. What I also think, though, is, so you're mentioning, I do encounter people where I sort of expand what I'll call behavioral tolerance bands. We have rebalancing, for example, where there are set tolerance bands where when stocks become too big of the portfolio, you rebalance back. And when you do have a certain amount of wealth, we do give people a little bit more wiggle room with their portfolios. Now, I also know that if we had a properly functioning crystal ball and it were to just put out right now in front of us the assets we need to hold that will definitively be the best portfolio 20 years from now, I also know that there's a good chance I won't be able to coach a person through that portfolio. People struggle holding international stocks, which is pretty basic right now. Who knows what the perfect portfolio would have? My question to you on that optimal portfolio perspective is, how does the optimal portfolio from a behavioral perspective differ from the optimal portfolio from a mean variance or a CAPM, basic modern financial theory portfolio?
So let me tell you a story about mean variance portfolios and behavioral portfolios and Harry Markowitz. So Harry Markowitz passed away not long ago. He was a good friend of mine. He was a mentor, a very dear man, a very smart man, but he also understood investors. So he knew his mathematics, sure, but he understood human behavior. So I met Markowitz almost 30 years ago, in 1995, at a conference, and I took the opportunity to sit with him at lunch. And I pointed to our plates, and I used that to explain the difference between mean variance portfolio theory and behavioral portfolio theory. I said this: in behavioral portfolio theory, we like our plate to have the beef, the steak in the middle, the mashed potatoes at one side, the broccoli on the other. We like the steak to be hot. We would like our beer to be cold. In mean variance portfolio theory, you take all of those ingredients into a blender, mash them all together, and eat them with a spoon or suck them with a straw. That is, from the perspective of the stomach, it doesn't really matter if it's a steak or broccoli. It is all minerals, vitamins, calories, and so on. But, of course, people care about those elements. People care about the special individual ingredients. People have goals. It might be education for the kids, it might be retirement for themselves, it might be a bequest, all kinds of goals. And Harry laughed as I was describing that, and that was the beginning of our friendship and his mentorship of me. And later on, we wrote a paper together with 2 other colleagues that combined the two, that said, what do you do when you have those different goals, for example, education and retirement and bequest? You put each of them into a mental account as if it belongs to a different person. You optimize each of them by the rules of mean variance, and then you combine them. And what we found was that under some conditions, that all of those 3 sub-portfolios lie on the efficient frontier, as well as the overall portfolio. So it is possible to do the normal thing to satisfy what people want, and yet have it optimal in the standard finance way, because still, we want it to be efficient.
I'm never going to think of modern portfolio theory ever the same after that. That is a wonderful example. And I think of, again, if we're tolerating some behaviors in those that we're advising based on their wealth, based on how bad the worst outcome of making a deviation from the steak dinner milkshake that you just described. I guess, I want to call out, obviously, neither you nor I are experts on fiduciary law, but I do know that we all try to do what is in our client's best interest. And so when you think about the difference between like the optimal behavioral portfolio versus the optimal mean variance portfolio, how would you, no one's really written on this topic about it being your fiduciary duty to do the right thing. How would you think about connecting those 2 ideas?
Well, I think about it in the context of what is a want and what is an error. So think, for example, about dollar cost averaging. Dollar cost averaging is not rational. If you want to invest in stocks, if you just got, say, $100,000 and you want eventually to invest it in stocks, invest it today, all of it, in a lump sum. There is both theory and empirical evidence suggests that is the way to do that. And if you received a bequest of $100,000 in cash, and you want it, in stocks, and you want it in cash, then sell the stocks today, and you'll have cash. In fact, if you are very averse to risk, and this is why you want it all in cash, surely any day you hold stocks, you expose yourself to risk that you're going to lose some of that money. Now, suppose that you face a client who has this situation. He just got $100,000 in stocks or in cash that he wants to put into the market, eventually in stocks. And you say, look, both theory and evidence suggest that you should just do it today. Just buy $100,000 worth today. And the fellow says, I don't know. What is the fear? The fear is that the stock market is going to plunge tomorrow. And the God of the market will always do that to you. Okay? As soon as you put in money, the market goes down just to tell you that you're stupid. So what is the real impediment? It is not attitudes towards risk. It is regret, which is an emotion that we all know. If the market goes down tomorrow after I invested today, I'm going to feel like an idiot. I'm going to have hindsight. Why did I do this stupid thing? I'm going to feel regret. Now, what you do when you do dollar cost averaging is you divide it, say, into 10 increments of $10,000 each, and you invest each in the coming month. And this way, you minimize your regret potential. Not risk is driving it. It is aversion to regret. Now, suppose that the client that you say, here's the rational thing to do. As a fiduciary, I'm trying to maximize your wealth. Here is what you should do. Invest it all today. Now, the client doesn't do that. The client is kind of like the fellow at the edge of the pool and you say, jump head first. And he says, no, I cannot do that. Isn't it better to say, why don't you put in 2 toes first, then your feet, then your legs, then the rest of your body? This way, at least he gets into the water. And so I think, I don't know what the lawyers would say, but I think that if you explained to people what the literature, what the evidence is, here's the rational thing, and then they say, no, I'd rather do it by dollar cost averaging, this is a distinction between what is an error and what is a want. Then dollar cost averaging is not an error. It is a want to minimize regret. And while regret is not something that we accept in standard finance, regret, whether you accept it in standard finance or not, regret is something we all have experienced, and we all are deterred by decisions that might impose regret.
I'm thrilled that you mentioned regret, because the literature suggests that regret is strongest when you can clearly see the alternative path. And there's nothing more quantifiable than what just happened in the market. And I think it's why people put so much pressure on them. So I'm thrilled that you bring that up. But that is also what my role is, and many of those in the audience role is to play a role in coaching and educating those who are helping. Can you speak to that a little bit?
Yes. So regret is an emotion that we describe as a cognitive emotion, unlike fear. Okay. So when you are on the highway at highway speeds, and the car in front of you slows down really fast, you don't say, what is the reason for that? Is there an accident? And so on. You just slam on the brakes. That is what fear does instinctively, and that is a good thing. Regret is a cognitive emotion in that as you're going to make a decision, you think you can see what can come out. What if I chose this job rather than the other one and this did not work out right? What if I chose this fund, say a value fund, over a growth fund, and it turned out that in hindsight, I know that it was the growth fund that was better. And so you really have to kind of accept that, and you have to know, and this really is where an advisor is an educator. I tell advisors, you are like me. You are educators first and foremost. And say, here's what regret is. It is familiar to you. I know that we are making a decision now, and the outcome will be only years from now. You might find yourself in a situation where you find in hindsight that you would have been better doing something else. In fact, diversification, one of the good things of diversification is that it can minimize regret, because I have some growth, I have some value, I have some domestic, I have some international. Unfortunately, clients, people, we will come back and say, why did you invest in international funds? Wasn't it clear at the time that it is not going to do as well? In fact, one advisor told me of a trick she uses with her clients. At the beginning of the year, when they meet for the first time, she has a set of questions. She said, like, will Donald Trump be divorced? Will California have a 7 magnitude earthquake? And so on. And people say, here's what I predict. Then at the end of the year, of course, they remember only those predictions that came true. So she can show them, or at least can threaten to show them the list, and then they realize that as they say, their forecast, their foresight is not as good as their hindsight, and perhaps they calm down. I'm not suggesting that it's easy to educate clients. you have to do it again and again. You think that you explained it, but you don't. The usual thing that applies to professors applies here. There's no such thing as a stupid question. There is not a statement of, didn't we talk about it last time? Just do it again. Because people are people, and you're trying to do the best for them. You're trying to improve their wealth and also their well-being.
I love this idea of advisors as an educator. And my father, he is a pediatrician, and it's obviously an evidence-based profession. And there's a lot of diagnostics involved, but then there's also points where the evidence isn't black and white, it's shades of gray. And a physician's job is to be an educator on those different options and help you make a decision that you will feel good about. Now, what I also learned from people calling my dad all throughout nights and weekends and asking for life advice is that the pediatrician was at a really unique intersect to sort of veer off of pure medicine and talk a little bit deeper into life. And I think that advisors have an equally good opportunity to expand beyond just the financial well-being and talk a little bit more about just well-being holistically. I know that you're doing some research on that topic now. I would love for you just to, what do you at a high level think about the difference between the financial well-being and the life well-being?
So I think about I talked about the standard finance where people are rational, the first generation of behavioral finance where we describe them as irrational, and the second generation where we describe them as normal. What I describe today, and there's a book that is at the publisher now, is what I think of as the third generation of behavioral finance. And in the third generation of behavioral finance, people are still normal, but people want to enhance their well-being, their life well-being, beyond financial well-being. Now, for example, what are the domains of well-being? Finances, and I'll come back to that, of course, but also family and health and work and education and religion and society. There are many dimensions to it. And so what we do is eventually, or what you do as an advisor, and you don't need to hear it from me to know, because this, I'm sure, is your practice. You are trying to enhance their well-being without detracting too much from their wealth. And so you might say to a client, why don't you share your wealth now? An old person, say in his 80s, why don't you share your wealth now with your children, family, charities, rather than wait for you to be dead? And so I say it is better to give with a warm hand than a cold one. The time to give is earlier, not when you die at 95 and your kid is 65. The time that kids need that money is when they are in their 20s. Yeah, you paid for the college maybe, or they have loans. This is the time for you to do that. Some years ago, I was speaking to financial advisors and about those issues of saving and spending and so on. And, after my talk, as I stepped down, people approached me talking about the need to save more and spend less and so on. There was one advisor who stood aside, and she said, when those others have left, she said, I started crying when you said it is better to give with a warm hand than a cold one. She, in fact, had tears in her eyes when she spoke to me. And she described how she lent her son some $27,000 for his education, for his college education. And now she insisted on him paying back by the agreed-upon schedule. Her reasoning was that this will teach her son financial responsibility. You signed the contract, you have to fulfill that. But that kid was now at the beginning of his career. And he did not even have money to buy his girlfriend an engagement ring. And of course, it soured their relationship. And so I hope that she got that message, that by forgiving that loan, which she could do, I asked her, she could do that without harming herself financially. She's going to lose something in the domain of finances, but she's going to gain in the domain of family so much more than she has given up. That is what I'm talking about. And so you need money for everything. You need money for family, you need money for health, and so on. But you have to ask yourself, what is money for? Money is just a way station to well-being. And this, I think, is a big part of what you do and properly do. That is trying to get people to get higher well-being, even if it costs money. Because eventually, of course, you cannot take it with you.
The idea of well-being, especially in the holistic way, we could be here for hours talking about. A lot of my listeners are people nearing retirement or having just entered retirement, and even for those who are currently retired, have been so for a while. Are there areas where you feel like that group should be focused on to enhance their well-being? Because they lose a pretty big part of their life when you go into retirement. There's obviously the giving aspect that you mentioned. What else would you tell retirees that they should be thinking on, and maybe even some things you think that they're failing to do?
So think about the difference between the time when you're working and earning money and saving and the time when you are retired. Now, I talked about dividends and the distinction between capital and income. So how is it that we are good at saving? And I'm pretty sure that all of you here are good at saving. All of you have good self-control. You know to delay gratification. So what you do is, as you work, you have a mental account for income and for capital, and that capital is saving, say, for retirement. Now, what you do is you move money from income into capital in the form of saving, whether it's 401k or some other means. And then you use that self-control rule that I mentioned before that says don't dip into capital. Now, again, people who have accumulated substantial amounts of money are people who are good at it. Now comes retirement. You no longer have regular income. Now is the time to dip into capital. But that is really a very hard transition to people. It really is hard for two reasons. One is that habits are hard to break. So for example, I wrote about it in an article in the Wall Street Journal. And one person wrote in comments, reading this article really changed my thinking. I went out and fitted myself to some expensive set of golf clubs and didn't feel guilty about it. And so some people, you can kind of say, hey, why don't you think about it another way? But then there was another one who said, look, you have stories about people who died with a lot of wealth, and people feel sorry about them because they didn't spend it on anything. But the enjoyment of that person was in being miserly and speaking and living way, way below their means. And then he said, in some ways, I am that person. And I'm thinking, that's very sad. That's very sad. And sometimes you have clients and you cannot just change their minds. They are just the way they are. But you should try. Another advisor told me how he persuaded a woman in that kind of situation to spend extra $500 because she was reluctant to take Uber or taxis to go visit friends, to go to museums because there are entrance fees and so on, even though she had a portfolio of $2.5 million and she was in her 90s. So he persuaded her to spend from her capital $500 a month. And she said afterwards that she might just go get a manicure, which she did not have since she was in her 30s. And so you say, well, that's a step. You know, she can surely spend an extra $1,000 or $10,000 a month and be sure not to run out of money. But you as an advisor, I as a teacher, we do the best we can under the circumstances.
You referenced at the beginning of this discussion on well-being a variety of different domains, and most of the financial domain is what a lot of what me and my colleagues focus on. But in your work, where do you find that money ranks among some of the different domains? Is there places we ought to be focusing just as much?
Well, of course. You know, if you ask people what is really important in your well-being, they're likely to say the first thing, family, not money. They're likely to say health. They're likely to say work, and not just earning money. You know, my identity is the identity of a professor. It is more than the fact that I get a paycheck out of it. And so they're likely to say friendship and so on. My point is twofold. One, money matters on its own. Contrary to the notion that after $75,000 really doesn't matter much, it does matter. People gain status from having money. People gain the sense of power. People reduce their fear having money. That really is important. But then you ask, what is really money for? And then you get into those domains where money can help. I mean, you cannot have a family without money. Okay, think about marriage without money. That's just the first chapter that leads to the second that says divorce. So you need money for everything, but money is not everything. And finding ways to convert money into well-being is really important. This is why I refer to advisors not as financial advisors, but well-being advisors. In fact, I use the analogy to physicians. I say, you are a financial physician. In the same way that Peter's dad cares about his patient as a physician in terms of the knowledge that he has. He's at the frontier of knowledge of medicine, but he also has good bedside manner. He also knows how to really listen, to listen in between the lines. Just as a physician, you know, there are many things that you hesitate to tell a physician. It's kind of embarrassing, you know. There are some things about our bodies that are embarrassing. But if you have a physician where you can disclose those embarrassing things, then you have gained the kind of trust. The two of you have established the kind of relationship that is not easily severed by somebody who charges a bit less per visit. The same applies to you. The reason clients stick with you is not because your portfolio is better, not your pie chart is better, not because you provide them with hedge funds or whatever it is. It is that emotional part, that well-being part that says, this person really knows me deeply and cares about me, and I can listen and I can follow him or her and know that I'm doing well.
I love those insights. I think even when I think of the advisors we hire at Plancorp, So we're celebrating our 40th anniversary this year. We were a fee-only financial planning firm in 1983. We didn't even invest assets, so we were just doing tax work, estate planning, financial planning, and that's ingrained in the culture, but a lot of the hiring that we did when I first started there was focused on the type of person who likes to read through estate planning documents and does do detailed tax projections, whereas now we're starting to think about who's the person who can have these deeply intimate conversations. Some of the folks at Shaping Wealth, we have it on a regular basis to do some more training than we've ever done in the past. And ultimately, it feels like the role of the advisor is adapting. And the advisor used to just be a stockbroker, and then they offered mutual funds, and they offered asset allocation. Now we're more broadly focusing on the full life picture. And we've talked a lot about retirees. I also feel like there's a lot of trade-off when you're a parent, and how you worry about your child's well-being, how you worry about your own well-being, and how that purpose goes on. Was there anything, and we do have to save a few minutes for the end for my final two questions, but quickly, is there anything that you can share for the people who are in the prime of their careers and are parents to kids and balancing all those different trade-offs for well-being?
Well, first, in terms of advisors, you can see the difference in the skill set. It is, yes, you have to be on the frontier of knowledge of finance. You have to know the tax laws. But you also need to know what it is that people want. You have to be able to speak with people, not as a psychologist, but as a friend, and say things like, you want to take your son off your will because he pissed you off. Well, why don't you pause a bit? I say, as a friend, give it a week, give it two, think about the consequences of that. Think about how your family is going to split when they read the will and one got money and the other did not. Will they speak to one another? And so when you are a parent, and some of you are and some of you will be, and I am a parent of two daughters, it is, as they say in one of the movies, you didn't come with an instruction manual. You do your very best to guide them while listening to them. And so, for example, my younger daughter didn't really like academics, still does not. She didn't really want to go to college. Eventually, my wife persuaded her to go to DeVry College and get a degree, an associate degree, as a technician, as an electronic technician. And she thrives at that. In fact, where she worked, she was promoted to engineer because she was doing the work of an engineer. And so it's not that we just let her find her way. We tried to guide her as much as we could. But we know that kids are not cars. You cannot turn right and left as you like. You have to listen as well as speak. It is a hard lesson to learn. I'm not suggesting it's easy. In hindsight, I know that it worked. But there were times when I was tearing my hair out, worrying that she would never do anything with her life. So you really have to do your very best and know that it might not fully work.
So every podcast guest I have, I ask the same two questions. They're all going to get mashed together at the end of the year. So we'll have the full season of guests. And the last time I was doing a live podcast, it was with Michael Kitzes, and we were in a box probably about the size of this couch. There was no air going, and this couldn't be more opposite, being in the outdoors. But also, the audience didn't hear the final question that I'm mashing up for everybody. So, Meir, let me ask you, what does it mean to you to be a long-term investor?
Well, when I think about myself as an investor, and I rarely think of myself as an investor, I think about myself as a person. What I think about is what money is for. And so I'm in this fortunate position where I never imagined that I'm going to accumulate as much wealth as I did. I remember years ago, my CPA said, Meir, you're paying a lot of taxes. And I said, I never imagined I'm going to earn as much as I'm paying in taxes, and I'm not going to spend my life complaining about taxes. And so I have more than I need. And so my wife and I, who is a graduate of Santa Clara, where I teach, we have established an endowment of several $1 million that pays really grants to faculty members in my department to support their research. This makes their life easier, helps their research, in a way helps all of us. And it also gives me that sense of pride. Yes, I gave up some of my wealth. I gave up some of the utilitarian benefits, but I also gained a whole lot of expressive and emotional benefit. That to me is to remember that I cannot take it with me. I can really share it with people who matter to me and causes that matter to me. And if I've been fortunate, it is, yes, I worked really hard and continue to, but I've been very lucky. And I surely can spend the luck portion of my money on other people.
Meir, thank you so much for the conversation. Thank you, everybody in the audience, for joining us today.
Thank you, Peter.